Hello, everyone. Welcome to the weekly roundup. Today we'll cover tariffs, global economic growth, and market sentiments. Hello, Ben.
Hey, Eva.
So we're gonna go right into it. The story at the top of the news: Liberation Day announcement by President Trump.
Yes.
Can you do a quick recap for us of the tariffs?
That sounds good. I'll do my best. I don't know how long President Trump spoke yesterday, but it was for a very long time and engaged and watched a good chunk of it. Look, there are major potential changes, impacts. He is trying to, I guess, equalize any types of tariffs that are put on his country back to their country. And I thought it was it's not necessarily a brand new way, but it is really pulling into question how trade is done globally. We're moving away from kind of a unified global system where people work together, and maybe you have global trade rules that you work within, and it appears that he's trying to move everything towards individual trade agreements globally. So that's a reset to the global system. And, when President Trump got in from his first time, at the time I'd said, we've reached peak globalization. And I think that continues to be the fact. And he's trying to move towards bringing things back to the US. Major knock-on effects of all that. And, the markets are in a bit of a panic this morning. It was certainly related to manufacturing. So a lot of the retailers like Nike and Under Armour and Capri, which would be Versace and those kind of higher end brands, any of the companies that bring their products from outside of the US into the US, like those stocks are getting hit today. Even some of the names like Apple and Amazon, like all these companies are being negatively impacted today. Excuse me. Um, but from Canada's perspective, and Mexico's perspective, it's actually, I think, a slight positive. The Seems to be they were left out of the equation. Certainly, yes, there's still some tariffs associated with that, but at least from what it looks like right now, the Senate ruled in favor of Trump not being allowed to proceed with increasing the tariffs on Canada and Mexico. So I'd say a slight positive to Canada, but we still got lots of road to cover and lots of information to try to understand. But I'd say on a big picture, simplistic views is what it was, which is you do this to me, I do this to you. So that's a real different approach than we've seen in quite some time. So that's why I think the market's a little bit uncertain as to what's ahead.
Okay, let's talk a bit about the trickle-down effect for global growth and inflation.
Hmm,
And we know that interest rate decisions are on the way in a couple of weeks. Would this
sure.
impact the outcome of those meetings?
Yeah, so I think I'd been of the thought that all of these tariffs, and we follow some pretty reputable economists who think that tariffs is massively inflationary. Larry Summers is one of the key leaders that's been talking about this. But as you think about the size and scale of the impacts that President Trump is talking about, you probably have more of a deflationary backdrop potentially because you've increased so much. If it was a small marginal increase, then I think yes, certainly inflation comes. But because there's such material impacts globally, you probably get slowing economic activity, which results in deflation or maybe less inflation. And so I think because of the severity of it, I'm starting to lean towards my thinking that maybe this is, as I say, either deflationary or disinflationary. And that really ties in with economic activity. And likely economic activity slows slash stalls with this backdrop. The one piece that has held true, at least for the past 50 years, and maybe it's different now, is that every time we get into this period where we see economic activity slow, unemployment start to rise, you get the reaction function from the central banks of the world to cut interest rate and stimulate the economy. And so they've been quite good at raising rates and quantitative tightening. So the balance sheets are as good as they've looked in quite some time, and interest rates are still fairly elevated. So, I think outside looking in, we're seeing economy slowing, but you have central banks in pretty good shape. So, those two pieces I think are important to think about for what can happen to markets and the economy in the second half of this year, first half of next year.
Okay. We're just going to talk about the market a bit. We've seen the knee-jerk reaction, but how long do we expect the market to digest this news, and what do we expect generally going forward?
Well, it's a great question. Do you have a magic ball?
I wish.
Look, I think we've talked, I know we talked about this, I believe last week, that there just is, these types of market activities and market events remind me of many that I've seen before from at COVID, we had this material correction sell-off. During Brexit, obviously, we had a knee-jerk reaction to the downside. And other types of events, obviously 9/11 and, the subprime housing one was different because it was more of a slow bleed. This one seems to be a bit more similar to the Brexit scenario, Brexit event, where you see a knee-jerk reaction down on a lot of things. Um, the companies, as I mentioned, the retailers getting hit hardest here. We're probably going to find out over the next couple of days to couple of weeks what the actual impacts are, because I'm certain a lot of these businesses had anticipated this or at least known it was going to happen, and you would have started to see factories and certain things repositioned. So, I think this is an opportunity. I think that when you see material corrections for no reason, and you're seeing the S&P down maybe 12% from the start of the year, and Nasdaq down closer to 15, 16%. These are material corrections and really present opportunities. So I think the question now is, like, what's that level? I think maybe is what you're asking me. What's that level where we floor and start to see a bottom? I think there's great opportunities here. And I think there's just so many now that you have to decide what do you want to do. From if you're a stock technician, which is what a lot of you see on TV, is you get a lot of chartists. And a chartist would want to see, okay, they'd want to see today huge, big blow off volume correction. Then you'd want to see the volume start to fade, bit of a basing pattern where stocks go sideways for a period of time here. And then as things start to turn up, then you'd be buying. So I think you'd see a lot of that. But for me, outside looking in, Apple down 8% today, 9% today, 20% year to date. Is a company any different than a number of months ago? By no means. So I think, there's tremendous amount of opportunity here where we haven't seen that for 18 months up until now.
Yeah. Let's go into the charts.
All right. Well, we are April 3rd. It is about 1 o'clock on April 3rd, just after. So anything that happens between now and then, end of the week, we can't comment on. Obviously, jobs numbers comes out in the US tomorrow. We saw a job report earlier this week as well that was a little bit better than expected. So we'd be watching that tomorrow. But here we are, April 1st. This was actually my last chart, but given that all the attention is towards this, let's just touch on this first now before I provide some comments on other charts that I put up today. But this was coming into the presentation yesterday. Just giving you a picture at what the US weighted tariff rates were. And so you may have caught some innuendos just around the fact that they have tried to do tariffs before. Like last time would have been during the Great Depression, we'll say. There's been global tariffs, and some things worked quite well and others did not. just this size and scale that we're currently looking on. We're following into this category now, which is based on what President Trump said yesterday, a reciprocal scenario. So this is reciprocal tariffs, is what he talked about in great detail yesterday. And so this was kind of worst case scenario, and this was current levels. So he came in with the reciprocal, you tariff me, I tariff you. And so I think the one thing that we need to remember is that it's not how it works. It's a lot more complicated than that. And so there's still lots of information to digest to think about what are the knock-on effects, do you say, like you said, Eva? And I think we need to think about that. But this is really stiff suggestions that he's putting in place. One of the things that I'd commented on earlier in the week, and it's not tariff related, was just really related to the amount of interest that's come to the Canadian bond market. And so one of the, I guess, things that I didn't and we didn't understand is just why has the Canadian dollar been so resilient, given the negative outside view around our economic activity and interest rate differential that we're seeing. And this was a great picture just to see that the IMF has been increasing their Canadian dollar reserves materially. And so as you look at these levels here, it shows you how much the IMF's been adding to their holdings in Canadian dollars and Canadian bonds. And so interesting to look at that. More FX reserve, given attention towards Canadian dollar, and non-residents have been buying Government of Canada bonds. Interesting as well. Just given the backdrop that we had, it's a bit surprising, but it also helps you understand why the Canadian dollar has been resilient in this backdrop. And so we'll see if that continues from here. But great chart that our economics team put together this week, and thought I'd flag it so we could have a look and try to understand a little bit why the Canadian dollar has been so good. And most of my meetings this week and even the last couple of weeks just around what's going on. And I think this is a great way to look at some historic events. And certainly in 2008, where we saw the S&P sell off materially, we saw global economic uncertainty, and these were new all-time highs at the time. You see these spikes in uncertainty, obviously in 2020 as well. In 2015, 16, we saw it. President Trump was in that time as well. Now we're seeing this again where this global economic uncertainty index is spiking. So this is a sentiment gauge. And so we're starting to see a correction now to the downside here. As I read all of the information and I try to digest it, there is a feeling that we've potentially reached peak tariff risk and headline risk. And so as you start to see that dissipate, and to your point, Eva, maybe it's a week, maybe it's 2 weeks or a month, but I think we start to see that dissipate to some extent. And that's when you start to see a sentiment shift in the other direction, because this is a global economic uncertainty. And as I've showed you in past weeks, we've had consumer uncertainty, we've had business uncertainty, we've had market uncertainty. And so now, as all of that and all the news that is being digested from yesterday, we probably start to see that move in the other direction at this point. Last point on the on this Canadian Government of Canada bond, we are going to issue a fair amount of bonds, 25, 26, and so that would be the red lines here. I think it's probably noteworthy just to look at where the majority of this is going to be issued. You get the biggest increases in the 5 and 10 years. So that's an interesting view on what's likely to happen to rates at this point, and maybe economic activity. And certainly lots will be on the short end. And we already know that Bank of Canada said rates are coming down. I still think they will. So lots of bond issuance ahead for Canada in 25, 26. That falls in line a little bit with my view that I think economic financial conditions and liquidity gets better. So I think that was a great chart just to look at that. As always, the opinions expressed today do not necessarily reflect those of NBF. If you have any questions, you should consult myself or your financial advisor, and we can address those on an individual basis.
Thank you, Ben. So what are we looking out for next week?
So I think certainly the remainder of the day will be interesting to see how things play out. We saw obviously a quick snap down. The Dow's still down here, 1,275 points today. We saw lower than that. We saw the market rally kind of late morning into lunchtime, and now it's trying to correct a little bit again. So certainly today will be interesting to see how much of the, I'd say, downside gets washed out today. There's a jobs number tomorrow, so that'll be key and important to watch. And so if we get anything outside of what they're expecting, if we get better jobs numbers, you could have a big move. If you have worse jobs numbers, then you probably get more of a correction. And so I'd be watching that tomorrow. But after a big sell-off like this, it'll be important to see how the markets react. And so tomorrow I'll be watching to see, do we continue to follow through? And if the answer is yes, then maybe there's something else to think about. I think the one key piece that I always think is important is what's the other assets doing, because everyone catches the headlines around stocks. And so, what are bonds doing? How are bonds reacting? What's happening along the curve? And I think if this was a panic, we're going down 25% tomorrow, you probably would have seen a more material move to the upside in bonds. So yes, we've seen some stability and a little bit of a boost, and yen's up about 2%, but we're not seeing this massive event that's causing me to think that it's anything but a correction at this point. So I'd be watching those variables and seeing what we do from here.
Great. Thank you, Ben.
Yeah, you're welcome.
For everyone, remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of our videos. For our clients, please reach out to me if you have any questions or if you would like to book a portfolio review meeting with Ben. Thank you for listening. Have a good weekend. Bye.
Thanks. Take care.